Let's talk to Marc Ostwald. He's a strategist at ADMISI. Very good morning to you, young Marc.
Good morning.
Right, 6 thought-provoking slides. You're on your soapbox. Off you go, dear boy. The first one, US CPI versus average hourly earnings.
Obviously, we've got the US labour data today. I think the important point, we are forecasting, or rather the market's forecasting that CPI rises to 2.8%, which would be the third time we've got to this cyclical peak, but it's been a bit of a struggle ever since September to actually break through that. More importantly, though, is we need to think about what wages are doing in real terms. And here's where the bad news is, and one of the things which will allow the Fed to not feel particularly a great deal of pressure, because they want to see average hourly earnings pick up. And as long as average hourly earnings in real terms, so the bottom part of that, the yellow line, is actually headline inflation, are signaling that basically there's no growth in real terms, there isn't actually a huge amount of pressure on the Fed. It allows them to do what they want without anyone telling them you're not responding to the incoming data. And I think that's a very important point. So what might change that? The other focal point in terms of today's data comes on the next chart, which is a chart I've put up very frequently. It's the underemployment rate. It's those people basically who are doing part-time jobs but would like full-time jobs. And it was very stuck for the back end of last year. Back end of 2017, we were in sort of 8 to 8.2 range. And given that when we were previously down at 4% in terms of the headline unemployment rate, that had got down as low as 6.9. It indicated to us that there was still actually rather more slack in the labour market than people thought. However, now we are starting to burn up that excess capacity in the labour market. We're down to 7.6. If it were to fall a little bit further today, which might not necessarily do, but if it were, then we start to get to a situation where with no spare capacity, even in those in part-time work, you are probably likely to see average hourly earnings start to pick up rather more significantly. So that's the US labour data. Obviously, the other big theme of the week has been this outbreak of trade wars between the US and China and the ongoing strength of the US dollar. And I think one of the sort of strange maxims that we have in financial markets is that the commodities world, a strong dollar is bad for the commodities world. Well, this is a table I produce every day with sort of where we are in terms of highs and lows on the various commodities. And I think it's instructive insofar as we've got some very, very divergent trends there. The top section is just the indices and Baltic Dry Freight Index, which has been interestingly rising very sharply, despite us being in a so-called hostile trade environment. You wouldn't have thought that's particularly good for trade, but it's up very sharply this week. The metals sector, above all the industrial metal sector, is faring particularly poorly. We'll come to copper specifically in a moment, but I think we've got quite a lot of divergent trends there. So in general, we are concerned that trade tensions between the US and China will lead to less demand for Chinese manufactured goods, particularly those of the industrial variety, and therefore less demand from China for raw materials. We'll see how that materializes next week in terms of their trade data, but that's by the by. But there'll definitely be one of the sectors which has been suffering very badly as a consequence of this, and obviously the sanctions on Russia, which impacted the aluminium market. By contrast, obviously, we have crude oil remaining very, very robust. And I think the point here is Mr. Trump can tweet as much as he wants to OPEC. You need to supply more. The key point that Mr. Trump seems to fail to understand is there's not actually much production excess capacity. Most of it lies in Saudi Arabia. If they were to make up for the shortfalls that we're getting out of Venezuela and Angola, and latterly also Libya, to a certain extent Nigeria, and on top of all that, whatever we see in terms of a drop in supply from Iran due to the US sanctions, then the 2 million excess capacity that they have to boost production would be used up very, very quickly. In fact, it probably would be less than sufficient, and we might end up in a situation in the back end of the year, actually, where we actually have a supply deficit. And one of the reasons for that is obviously that we had that weakness in 2015, 2016 in the oil market. And a lot of the upstream investment and the E&P exploration investment hasn't been going on because the oil majors have been fearful that this rally in oil markets may not be durable.
Yep.
But it does leave us with this situation whereby one can probably safely assume that both the Angolan and Venezuelan production aren't going to suddenly rematerialize from anywhere, even if Venezuela saw regime change. So the upward pressure is there on oil prices. That's obviously very important in terms of global inflation outlook. It's a very key component. And it also leaves a lot of emerging market countries which are net oil importers. Best examples, obviously, Turkey, as always, India, South Africa, particularly vulnerable, and obviously at risk of some pressure from the broader populace because everything is about food and petrol at a more basic level. So now let's go on to something which everyone considers to be one of the great bellwethers. We've had a rather negative narrative of late about the outlook for the global economy. In the first instance, predicated by the slowdown that we saw in the first quarter in Europe, which, judging by the PMIs that we've seen, judging by the orders and production data that we've seen in Germany, was probably just about weather, some strikes, and a flu epidemic in Germany. But we are now sort of looking at the copper chart, which had an outside trading month last month, which is extraordinarily unusual. And we see the health of the copper market, particularly in price terms, as being a benchmark for the global economy. So it's going to be very interesting here. I've drawn that line across the chart to basically signal if we don't find some sort of support here, then that would offer a fairly poor signal for the global economy. But then again, we may have just reached the nadir point. Certainly from what I'm hearing from the copper market, a lot of people feel it's very, very oversold here, as are the industrial metals overall.
But on the technicals, that looks a very heavy chart to me.
That's a very, very heavy chart, but it's also a very oversold chart.
Yep.
Without a shadow of a doubt. So that's why that line across there is so important, because there is a lot of congestion on the chart and we should find some support there. Obviously, the congestion area that you see on the left is basically after we had the big jump post-Trump's election. That's where we consolidated, and that's why it's important that that area holds.
Understood.
Last but not least, let's go to soybeans. This is a chart. If that one was negative, this one's friendless. Now, there's an important distinction to be made here. This is largely friendless, and it's important because soybean exports from the US to China are obviously amongst those things which the Chinese are targeting specifically. Not very good news for one of Mr. Trump's core support areas, i.e. the farming community, who he hasn't actually done a lot for. The whole tax reform business was not exactly good for the agricultural producing community. But I think there's an important contrast to be made here. This is the CBOT US soybean future. Now, I haven't got it with me, but if you actually had a look at the one in Brazil, you would actually see it going in completely the opposite direction.
Right.
And I think the key point here is, my initial point was, a strong dollar is bad for commodities. Well, probably it may exacerbate certain moves, but in the longer run, with most commodities, there are core principles to do with the supply and demand outlook, be that soybeans, be that copper, be that oil, or any of the others, which will always end up overriding whatever the dollar's doing at any given point in time. And that's, I think, an important lesson to remember when one applies these wholesale maxims that a strong dollar is actually bad for commodities.
On that note, young Mark, we've run out of time. Thought-provoking as always. Thank you very much indeed.